Hello and welcome to the Cedar River Capital fourth quarter market update slideshow. Date today is December 17th, 2022, and we'll be discussing the main driving factors in the stock market at present, that is the market touchstones. My name is Paul Latta. I'll be doing the speaking for the slideshow, but my business partner, Baj Kochar, and I are both available for questions and discussion. Contact information is on our website at cedarrivercapital.com. Our agenda for today will begin with a discussion about recent market action, what's hot and what's cold. Then we'll move on to a top 5 points of discussion amongst investors today. And then we'll conclude with a handful of lower profile observations that we believe to be important but under the radar. To begin with a little perspective, this is a chart of the S&P 500 over the last 5 years. Good news is that the S&P is up 54.4% in the prior 5 years. But of course, 2022 has been a challenging year so far, with the S&P down about 15% year to date. The market narrative today is revolving around 4 key areas of debate between bulls and bears. To begin with, bulls are quite enthusiastic about the Fed scaling back rate increases at its meeting just last week, a sign that peak inflation may be behind us and that things are returning to normal. Bears, of course, point out that the Fed is not done yet, and while rate increases are slowing, rates are still going higher and recession risk is actually increasing. On COVID, bulls are enthusiastic that things are returning to normal here in the US, as evidenced by recoveries in travel, destination entertainment, and other hard-hit sectors. Bears, however, point out that China is just entering a new COVID infection wave with the reversal of the lockdowns there, and that wave will likely disrupt supply chains worldwide. On valuation, bulls highlight that the market multiple, or the PE ratio, is nearing 5-year lows, and that valuations are therefore quite compelling. Bears, however, will highlight that the market multiple may be compelling versus its historic range, but is not very compelling relative to interest rates. If you double interest rates, the market multiple should be cut in half. We're not there yet. On the Ukraine, bulls will highlight that the front lines have seen very little movement and that we're in some sort of uncomfortable but seemingly stable situation right now. Bears will point out that the recent stalemating does not necessarily portend longer-term stalemating, and that there's an ever-present black swan risk to the conflict. When breaking down the S&P 500 by sector, you can see the last 3 months have been modestly positive, with more green than red in the top chart, but not positive enough to lift the year-to-date chart at the bottom, as the year-to-date chart has most sectors in the red. Recent results also reveal that the underperforming sectors, namely the communication services and consumer cyclicals, have not really bounced back as the year progressed, but rather continued to underperform. Energy, the best performing sector in the first half of the year by a wide margin, did not continue to outperform, but rather market performed in the trailing 3 months. Defensive sectors in general, healthcare, consumer staples, and utilities, outperformed over the course of the year, perhaps not a surprise given the hawkish central bank policy over the most of the year. How has the US market done compared to other markets around the world? Well, not a whole lot different. This chart shows the US market down 14.9% through December 14th, that is, which is just a touch below the middle of the pack, but there is a wide spectrum of outcomes ranging from Turkey's 90% plus gain to Vietnam's 40% loss. 2022 has been a decent year for the Latin American bourses, which seem to be attracting inflows mainly due to outsized oil exposure amid recent inflation, especially in Brazil and to a lesser extent Mexico. It's uncertain how persistent those gains will be, with the hawkish central banks worldwide raising rates to stamp out inflation. China markets have been weak, mainly related to the COVID-0 lockdowns. Equities have rallied a bit as lockdowns appear to be reversing now. Other Asian countries with economic ties to China, like Vietnam and South Korea, are seeing knock-on effects of China's COVID policies. The 90% rally in Turkey's Istanbul Stock Exchange is a bit eye-catching and mainly reflects the overdue stabilization of the lira, a deeply oversold market amid a controversial central bank policy, plus some level of NATO favoritism amid the Ukraine conflict. Investment returns by asset class this year have been noteworthy on a handful of fronts. First of all, 2022 has been one of those unusual years where both the stock market and the bond market are down, and down about equally. While the year is not quite over yet, it appears this will be the first such simultaneous decline in over 40 years. Also, a 15% decline in the stock market is not unprecedented. Indeed, in 2008, the market declined 39%. But more than a handful of pundits have pointed out that a 15% decline in the bond market has been the worst bond market in over a century. Commodities were actually up in 2022, but not uniformly. Food and energy have been up, but base metals and softs like cotton and lumber have been down. The slide also shows a Bitcoin down 63%. I'm not quite sure if crypto actually qualifies as its own asset class here, since it really seems to be tracking aggressive risk assets, more so than something like currencies, commodities, blue chip stocks, and bonds. In a way, cash has been an unheralded hero in 2022. While gains have been tiny, 1%-ish through November, the gains were positive and consistent across the asset class. There were no losing cash equivalent subsectors. Returns by style factor in 2022 year-to-date are shown in the far right-hand column. And as we've seen over the course of the year, the soft market has been kinder and gentler to the more defensive styles such as income, value, and low volatility, and it has been more challenging to the higher risk strategies such as story stocks, growth, and momentum. The fourth quarter to date performance is in the second column to the right, and the performance here is actually a bit anomalous. The market is up in the fourth quarter through December 14th, but the two best performing sectors have been income and high beta, sectors which are usually on opposite sides of the table. Also, growth and story stocks, which usually have a disproportionate number of high beta stocks, were the two worst performing sectors when one would have expected outperformance. We suspect the anomalous fourth quarter outcome was due to a variety of crosswinds, including year-end tax factors and portfolio repositioning around Fed policy softening and midterm elections. Now I'd like to move on to Chapter 2 of our slideshow, which is our top 5 list of the most discussed debates on Wall Street. Our top 5 list of points of discussion includes: will there be a recession in 2023? Has the Fed beaten inflation? Have other central banks beaten inflation? What does China retracting its COVID-0 lockdown mean? And will physical real estate track the stock market lower? Will there be a recession in 2023? Well, there's clearly elevated fear of a recession among fund managers. This Bank of America fund survey shows about 3/4 of fund managers believe that a recession is likely. This is shown by the purple line. Such strong consensus in the past has correlated with actual recession. Just under 60% of the fund managers are also telling their portfolio companies that they prefer companies' direct cash flow to improving the balance sheet rather than investing in the business. This can be shown in the blue line. It's not quite as elevated as the purple line, but both lines are suggesting recession. The recession fears are coinciding with other recession indicators, of course, such as the record yield curve inversion, the soft lumber prices, surveys of S&P 500 companies, and surveys of economists. Recession can lead to sharp declines in earnings projections. Earnings estimates have softened since mid-year, mainly due to hawkish Fed policy. The downward revisions have been modest, but are still a bit troubling since bottoms-up industry analysts are kind of notorious for not forecasting recessions. Some sectors, of course, are more vulnerable to higher rates than others. Interest rate sensitive sectors include most industrials and many financials. Consumer staples are usually thought of as a safe haven, but this time around, consumer staples are having challenges with the inability to push higher costs through to consumers. In contrast, healthcare, utilities, and select producer staples are seeing very little in the way of downward earnings revisions. More than a handful of pundits have suggested that the Fed will keep raising rates until the labor market softens. There is some merit to this thinking since wage inflation, unlike commodity inflation, well, wage inflation is unidirectional. Wages only go up, they never go down. So wage inflation is higher on the list of Fed targets. However, most measures of the labor market are actually lagging economic indicators. That includes unemployment, payrolls, jobless claims, wage inflation. Businesses are always reluctant to hire and reluctant to fire. But there's at least one labor metric that is a leading indicator. That's the temporary help index. You can see in the chart here that temporary help peaked in August and has softened a bit, but only by a tiny 1% and coming from a fairly high level. Still, further weakening from here would be a cause for concern. This slide shows how much corporate earnings declined during recessions by looking at the last 4 recessions over the prior 35 years. On average, earnings dropped 47.4% during these prior recessions, though not all recessions are equal. The Great Recession of 2008 hit corporate earnings the hardest, dropping earnings by 77.5%, whereas the 1991 Gulf War recession saw earnings drop a comparatively mild 27.4%. Of course, the economy is cyclical and recessions are followed by recoveries. The average earnings recovery over the 2 years following a recession was 152%. And generally, the bigger the recession, the bigger the recovery in earnings. Moving on to number 4 on our top 5 list. Inflation has been moderating since peaking in June, but inflation remains high by standards of the last few decades. The stock market has been fixated on the peak inflation and peak Fed narratives through most of this year, as hawkish Fed policy remains the biggest overhang on the stock market. Might mention that the chart here does not have the latest November CPI figure of 7.1%, a figure that shows further softening of inflation. Notably, though, most of the inflation drop since June has been coming from energy, partly reflecting seasonal declines in elevated post-COVID summer travel. Core inflation and food inflation have been stickier, so we're not out of the woods just yet. Looking into the November CPI inflation report in more detail, we can see several categories showing double-digit year-over-year increases are now showing month-to-month declines, a good sign. Energy and transportation fall into this category. New and used vehicles have been in the headlines in the last year, but those categories have cooled off considerably. Shelter, both renting and owning, has been problematic in reports over the last year as well, but is also showing meaningful signs of cooling. The food category still remains fairly hot, both grocery and restaurant, though not as hot as this summer. Can the Fed contain inflation? We believe the answer is yes. Hotspots are already starting to cool, and some categories like shelter seem especially vulnerable in coming months. Of course, there is a lengthy history of success supporting the Fed going back to World War II and before, and the Fed is not exactly acting alone here, as most central banks around the world are executing similar plans. That said, the road ahead will not be smooth and easygoing. Food inflation in particular remains persistent and has comparatively little sensitivity to higher rates. Also, the second largest central bank in the world, the European Central Bank, has limited ability to fight inflation, which we'll discuss in subsequent slides. And then lastly, China appears to be moving past its COVID lockdowns, which will initially seize supply chains but then surge demand. So the Fed seems likely to succeed, but the road ahead may not be straight and easy. Moving on to number 3 on our top 5 list, have other central banks beaten inflation? Today's inflation is a global phenomenon. Inflation in the OECD countries is just over 9% as of October. This is a bit unusual. Inflation is usually a regional phenomenon associated with some form of country imbalance, such as a trade deficit or a budget deficit. But the COVID pandemic was a global phenomenon, and the recovery amid constrained supply chains is happening everywhere at roughly the same time. Most central banks eased interest rates at the beginning of the pandemic and are now raising interest rates as we exit the pandemic. This slide gives a nice global overview picture to visualize the scope of the hawkish central banks around the world. Most regions of the world are indeed raising rates. Most central banks are acting in coordination with the U.S. Federal Reserve, but not all. To the right of this table, we can see that some banks are acting in virtual lockstep with the Fed: Canada, Mexico, United Kingdom. Some are nearly in lockstep: Taiwan, South Korea, Singapore, India. Some are actually leading the Fed, like Brazil, and some are lagging quite a bit, like the Eurozone and Switzerland. And there's 2 in particular that are actually decoupled and not raising rates at all: China and Japan. Is global coordinated response really needed? Well, there are pros and cons. Bank coordination today is more reflective of a common global shock, the pandemic, rather than the need to coordinate. Indeed, it's a bit eerie how press releases from the Fed read the same as press releases from central banks in virtually every place in the developed world. Nearly all are presently seeing signs of inflation cooling. Now, one advantage of actual coordination is that the matching rate moves prevent currency movements on deviations in interest rate parity, and that is an advantage of coordination. That said, banks that deviate from script usually have unique country-specific factors. We'll talk about that on the next slide. There are 3 central banks that are clearly going off script from the rest of the world. The European Central Bank is basically caught between a rock and a hard place, as they face a more sizable inflationary threat, being neighbors to the Ukraine conflict, and have been cut off from most of the Russia gas supplies. Yet there are still issues with sovereign debt obligations, especially in the southern member countries, that make quantitative tightening effectively impossible without threatening the unity of the European Union. Still, recent Eurozone inflation of 10.1% actually declined from the prior month of 10.6%, so even the Eurozone is actually seeing a little bit of softening of inflation. Bank of Japan is still engaging in quantitative easing, mainly reflecting the decades-long challenge with deflation. Japan is one of the few countries in the world that is welcoming a little inflation. China is also maintaining a dovish stance, mainly related to the COVID-0 lockdowns. Of course, lockdowns are being reversed. A post-infection recovery is likely to see China's central bank become more hawkish, perhaps sometime in the first half of next year. Speaking of China, the reversal of the COVID lockdowns comes in at number 2 on our top 5 list. To begin with, it helps to remind us why the COVID lockdowns happened in the first place. Well, first, China was more vulnerable than most of the rest of the world. Chinese vaccines are less effective. Pfizer and Moderna are actually not in China, only Sinovac. Most of the elderly are not vaccinated. Hong Kong had a very bad experience in the first quarter of this year, and China does have more urban density. Secondly, though, there was also a political element to the lockdowns as they coincided with the October election of Xi Jinping as chairman of the Chinese Communist Party. The lockdowns are a means of social crowd control and a means of blame shifting. With the October elections done, the lockdowns are being reversed. Civil unrest has been a factor, as has economic stagnation. And of course, China is dealing with Omicron, which is less threatening compared to the original Chinese strains, so the lockdowns are being reversed. The lockdown reversal is likely to tread a familiar COVID path for investors, one of short-term pain followed by longer-term gain. We're already seeing signs of higher infection rates and are likely to soon see China-related global supply chain disruptions. We expect signs of long-term gain will begin to manifest in the first half of next year. The lockdown reversal is likely to have a ripple effect on global central bank policy since it creates two possible inflationary impulses. The first is the risk of supply chain disruptions in coming days and weeks due to widespread COVID infections in China. The second is the risk of demand shortfalls as China builds herd immunity and restarts the economic engine. Investors will need to keep an eye on China and its opportunities and its risks. Moving on to number 1 on our list. Will real estate track the stock market lower? After all, real estate has seen modest softening, but not anywhere near the softening of the stock market. The Case-Shiller Residential Real Estate Index peaked in June and has since softened by 2.6%, not really tracking the 15% decline of the S&P through December 14th. Of course, both are down mainly because of higher rates, but stocks are liquid and real estate is not. Commercial real estate is faring about the same as residential real estate, down just a blip. Cap rates troughed in the first quarter of 22 at 5.4% and are presently at 5.7%. By comparison, stock market earnings yield troughed in late 2021 at 4.4% and is now 6.1%. Both are up mainly because of higher rates, but again, stocks are liquid and real estate is not. Will physical real estate equity track stock market equity lower? Probably not, but physical real estate seems unlikely to outperform stocks at this point. Mortgage rates have more than doubled, and real estate is highly dependent on cheap financing. Higher rates have increased attractiveness of alternatives like renting instead of owning, or like buying corporate bonds at 6% instead of real estate at 5.7% cap rates. That said, real estate does not track interest rates super tightly, mainly because mortgages can be refinanced at a later date when rates come back down. Further, real estate prices have always been sticky to the downside since owners are generally not willing or able to sell at a loss. And of course, it's quite likely that real estate simply flatlines here while stocks rebound over the next couple of years as central bank policy becomes less hawkish. Indeed, that seems to be the most likely outcome. Stocks rally, real estate flatlines. We'd now like to move to our final chapter of our slideshow, which is a collection of 5 simple observations. With Russian gas shipments to the Eurozone now effectively at zero, Europe is rapidly building its liquefied natural gas (LNG) import capacity to address the shortfall. Most of the new import capacity is actually using the new technology floating LNG regasification. This allows a scale-up in roughly a year compared to the traditional landed LNG regasification, which typically takes 5 years or more. There's only a handful of suppliers in this market, including Accelerate Energy, New Fortress Energy, Hogue, and a handful of the oil majors. The gas shortfall should be at its nadir this winter, and likely to be a non-factor in the winter a year from now. The Russian-Ukraine conflict continues to make headlines and impact the stock market, so we do need to include a slide on the topic today. In recent weeks, the front lines have seen fairly limited movement. A no-movement scenario is actually not necessarily bad for the stock market, though of course black swan risk is still very present. Longer term, we see some merit to Henry Kissinger's plan from last May for Ukraine to cede Donetsk and Luhansk to Russia, and possibly the Kherson and Zaporizhia oblasts east of the Dnieper as well. This suggests the front lines are unlikely to move much from here, but again, black swan risk remains very high. With central banks raising rates in most of the developed world, bond rates have improved. Have they improved more than stock market valuations? Well, yes, they have. This chart compares the earnings yield on the S&P 500 to the yield on the 10-year Treasury bond. Bond yields have lifted much more than the stock earnings yields. While stocks are still the better value and have been since 2001, bonds have made solid progress. Some allocation to bonds is merited at this point. There's no rush, of course, since the Fed is still raising rates, but a bond allocation does have merit. We generally have a preference for lower risk bonds, U.S. issues, investment grade, maturities less than 5 years, but at this point, bonds are looking better. Share buybacks remain relatively robust at $210 billion in the third quarter. That's down about 10% from a year ago, but still above the 5-year average of $182 billion per quarter. The decline has some level of correlation with the stock market, but more importantly, we're not seeing any signs of panic. Share buybacks remain in good shape. There has been some concern that share buybacks would soften given that the new Inflation Protection Act from this summer included a new share buyback tax. It's a small tax at only 1%, but it could be an excuse to slow share buybacks amid fears of recession. That has not happened. Share buybacks remain solid. With fears of recession running above average, this slide shows that the stock market does worse before a recession than during a recession, and the stock market does quite well after a recession. In the 1 year before a recession, the stock market declined on average about 3%, whereas in the 1 year after a recession, the stock market appreciated 16%. If the fund manager survey from slide 11 proves prescient, and 2023 indeed includes a recession, then the 15% decline in the stock market in 2022 would be quite a bit below the normal pre-recession pullback of 3%, and indeed just behind the record 23% pullback of the dot-com 2001 recession and the 18% pullback before the 1973 OPEC recession. But looking into the subsequent 2 years, the average return is about 20%, a figure that would put us back at all-time highs again. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.